Is investment-based life insurance worth it? In this video, I'm going to be talking about all the different types of tweaks and turns when it comes to investment-based life insurance or variable universal life, and when it actually makes sense to use something like that. Hi, my name is Pascal Manget, and you're watching the Financial Ownership Podcast. So there's many different types of permanent insurance policies. There's whole life, there's index universal life, there's regular universal life, there's variable universal life. But in this video, I'm going to particularly focus on variable universal life. So if you wanted to take a chart to analyze the risk of permanent life insurance, whole life would be first, in the middle would be index universal life, and at the very end, it would be variable universal life. And as you get further past the risk spectrum, the most risky policy is variable universal life. And I'm going to be explaining exactly how it actually works. And the reason why variable universal life is the riskiest is because it's directly invested into the stock market. It's not indirectly invested. So you're exposed to complete market risk. So the good thing about it is you have unlimited upside. So you could get up to whatever the market does. So if you just put your money in a variable universal life policy before the coronavirus pandemic, for example, you could have got 30-40% uncapped gains on your policy. But the downside is that it has unlimited risk as well. So when the markets go down, your money goes down as well because it's completely exposed to market risk. And generally how variable universal life policies work is there's a separate account. So some of the money that you put into the policy as premium goes into the costs and fees that you would see in a typical insurance policy. And another part of the money that you put in as premium will go into a separate account, which is invested into mutual funds. And there's a reason why variable universal life is actually more risky than investing directly into the stock market. Because not only are there the management fees that you would have in an investment account when you invest into some sort of mutual fund, there's also the cost of insurance. And the cost of insurance can increase to you as a policyholder anytime when it comes to variable universal life. And the reason why is because the net amount of risk to the insurance company can increase. So let me give you a simple example so you could see exactly what I'm talking about. Let's say 1 year you have $200,000 into your variable universal life policy, and you have a $1 million death benefit associated with that. I'm just going to keep these numbers simple. It doesn't mean that it's something that's likely to happen, but just to keep it simple. Let's say there was a 50% crash on your portfolio or your variable universal life portfolio. That $200,000 cash value would turn into $100,000. So that's the typical risk when it comes to investing in the stock market. So whether you invest in a variable universal life policy or you invested directly into the stock market, you're still going to have that risk of losing some of the equity in your portfolio. But another part of the risk when it comes to having a permanent life insurance policy, when it comes to investment-based life insurance, is that the cost of insurance to you is going to increase. And the reason why is because when you first had the $200,000 in the policy and your death benefit was $1 million, the net amount of risk is what you get charged at. So $1 million minus $200,000, that's $800,000. So that's the net amount of risk to the insurance company. And that's what the insurance company is charging you. They're only charging you for that $800,000. But if your money goes down in value, say it goes down 50%, now the net amount of risk to the insurance company is $900,000 because 1 million minus 100,000 is 900,000. So now there's more of an insurance benefit that's going to be at risk to the insurance company, and they're in turn going to charge you more fees of insurance because of that. And that's why investing in a variable universal life policy is more risky than even investing into the stock market. So the benefit of this is because there's the unlimited risk potential when it comes to investing in a variable universal life policy. You could also expect the highest return long term in a variable universal life policy. And the thing is, the only way something like this would actually work, there's only a few scenarios where I think it's necessary to, or it might actually make a little bit of sense to use a variable universal life policy. I'm not a big fan of them. It's not something that I would personally own, but it's not necessarily a bad vehicle, and you could use it in some way, shape, or form to accumulate the money that you have in a tax-free manner. So the main purpose for a variable universal life policy is to maximize accumulation. It's not for distribution and income. So there's only two real reasons why I would think someone would actually use a variable universal life policy. One would be, say it's a young person, someone that's under 35, that maxed out their Roth accounts already, and they still want some tax-free income that's uncapped, and they could basically get exposure to the full market returns. So using a variable universal life policy would fit a need like that. Is if they want to have full market exposure and they already maxed out certain Roth accounts that they have. The thing is, the Roth accounts are going to be a lot less expensive considering that you invest into low-cost index funds. So it would make more sense to invest into your Roth accounts first before you use a variable universal life policy. And the second reason would be just if someone is under the age of 35 and makes too much money to invest into a Roth account and still has a need for tax-free accumulation. And they prefer to have uncapped accumulation versus capped accumulation. So there aren't that many ways that you could actually get tax-free income, and using an insurance policy is one of the ways, but these policies are only really good for accumulation because when you start to get to the distribution phase, it ends up being really risky if you still have a variable universal life policy. And the reason why you don't want to do this when you're older is because that cost of insurance risk is going to get higher and higher as you get older. So it's only really something you want to take advantage of if you're younger. You don't want to do something like a variable universal life policy in your 50s, 60s. That'd actually be very risky because the cost of insurance can increase and you have unlimited market risk, and you don't want that combination. But when you actually get to the point where you're at a distribution phase, where you accumulated enough money in your variable universal life policy, what you can do, what some insurance companies let you do, is transition your variable universal life policy into index universal life policy. And that way, so whenever you take distributions from your policy, you're not worried about market risk. Because one thing you don't want when you're taking distributions from any asset class is to have severe changes of the value of your portfolio. And the thing is, when you have an index universal life policy, you have a cap and floor built in. It does cap you at an amount, it may cap you at say 10%, but at least you're guaranteed a floor of like say 0%. So if the market goes down, you're not concerned. So the value in your cash value life insurance policy is still there, and you could use it for supplemental retirement or supplemental income for whatever endeavors you want. In my opinion, I think there's better alternatives when it comes to directly investing, whether it's the stock market and real estate and other things. I think that insurance policies should use primarily as a savings alternative to invest in other things. But it's not a terrible thing. There are some ways that you could use a variable universal life policy to your benefit, and you just need to understand the different types of nuances and risks that you're taking when it comes to getting a policy like that. If you found some value in this video, go ahead, like, comment, subscribe. I post content like this every single week. So if you're interested in different types of financial products and financial concepts, feel free to like, comment, subscribe. And in the description below, if you have any questions, whether you want to ask about different types of financial concepts that I talked about in the past, feel free to book a call and ask me any questions as you want. Thank you.